Over my career, one of the truths about financial crises is they generally come from financial factors that are actually quite obvious but are just misread. I think the financial crisis of 2008 was around AAA securities, the market believing that they posed no risk. The financial crisis of 2009 was the acceptance that a Eurozone sovereign was a Eurozone risk, and that didn't turn out to be right. So there's something out there that I always think that we need to take a different look at to see what might be the next issue. Clearly always look at credit, clearly always look at liquidity. Basically a break of liquidity in a certain credit market more often than not is what leads to the next financial challenge. I think the banks are in a much better position now. They're far more levels of capital, far more liquid than they've ever been. So I don't think the financial challenges will come from the banks this time. I think it'll come from some other part of the ecosystem of finance. And getting this whole issue of liquidity and risk fine-tuned, given the amount of sovereign and corporate debt that's out there, the stakes are high.
Jes, the interesting conversations in Washington, I think, were exactly what you're talking about. It was about the shadow banking world and the credit creation and the risks being taken, particularly in this low interest rate environment, potentially by insurance companies and fund management businesses. Do you think that is where the regulators should be looking more closely at this point? Should the scrutiny be on the non-bank financials perhaps and the risks that they may be taking around the low interest rates?
So I think the lowest interest rates pose a number of challenges. First and foremost, it is very hard to manage a robust, healthy banking and insurance industry with very low interest rates, let alone negative interest rates. The second real challenge of negative or low to negative interest rates is if basically the risk-free rate is less than zero, how do you value all the other asset classes? And I think what you leave yourself open to are some really strong asset class bubbles. And then those bubbles will be played into the non-banking financial market, as you said, whether it's CLOs, whether it's hedge funds. It does put the financial architecture on a more difficult footing. And I think a lot of what I heard in Washington and what we've been talking about is you do need, if we come into economic weakness, I think you do need a fiscal response in partnership with your monetary response, because with interest rates at this low level, I think accommodating central bank policy won't be sufficient to keep the economy moving forward.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.